All right. Today is Tuesday, June 8th. This is a recap for the stock market activities today. Let's start by apologizing for my regular viewers. You might read some of the titles of the videos or the thumbnails and think that I have lost my mind. But remember this. If you see a title that says AMC stock is about to go $10,000, all what I'm trying to do is attract the apes to click on the video, and then within the content of the video, they'll start to realize that this is not an ape-friendly channel. In the meantime, they take our channel, my channel, it's not your channel, it's my channel, but you're within the movement, bro. But they take the channel to the moon, and we have to exploit the mania in whichever way we can, making money out of it, making more views, and making more subscribers. With that being said, here are the main events for the market today. Number one, move over boomer apes. AMC is for boomers. We have new, hot, fresh, shiny objects to chase. And here it is. Are you ready for it? Drum rolls, please. Wendy's. Yep, food poisoning optimism. Wendy's blasting higher, the latest of the meme stock mania. To the moon, bro. But the skill is how to spot these stocks before they pop. But before we talk about that, you know, the apes, the Wall Street bettors, the Robin Hoodiots, the donkeys, and the likes. They keep saying, this is about the shorties, bro. We're beating the shorties. We're beating Wall Street, bro. Well, Wendy's has about 4% short cover. So this is not about short covering. This is about two things. Number one, hedge funds playing games by pumping these stocks. Who the hell thought about pumping Wendy's stock? Certainly not retail traders. You have all of these anonymous accounts over at Reddit and the likes, and these are hedge fund guys pumping certain stocks, pretending to be retail traders. And the evidence for that is the fact that Wendy's popped higher during the pre-market. Ask yourself a question. What is the percentage of retail traders who trade in the pre-market? Once again, these are games played by hedge funds, and the retail traders follow and intensify the mania. But remember what we talked about during yesterday's video. We talked about the IV rank, the implied volatility for all of these stocks. We know that retail traders and even the hedge funds are pumping these stocks via buying call options, meaning regardless of hoodle to the moon, bro, let's stick it to the hedgies and the man. That's all garbage, because if you want to stick it to the man, you buy the stock and you hoodle forever. You don't buy the call options and pretend to be an ape, because you're buying the call option expiring this week, and you are just like the rest of us, motivated by greed in the short term. You want to pump, dump, and make a quick buck. And the skill here is to find stocks with low IV before they pop, because if the IV rank starts to blast higher, yes, these stocks will move higher. Case in point, Clover moving by the tune of over 100% today. But the problem is, as the IV rank starts to climb higher, these option premiums become more and more expensive, and they don't move by much. For example, let's take a look at AMC calls. And I took these screenshots from Robinhood at the same time, early in the morning, when all of these stocks were popping higher. AMC stocks were actually down because the premiums were so high. Even after the stock moved higher, that was not enough to appreciate the premiums for these call options. On the other hand, GME, GameStop, the calls in that name were printing a decent amount because the IV rank was not high to begin with. What about Clover? The stock moves by 100% and the calls print 200, 300, 400%. That's impressive on paper, but not so impressive given the fact that the stock was up over 100% in a single day. We usually make 400% in an options trade when, say, a stock like Nvidia pops 5% in a single day. But here it is, one stock had pretty much zero IV. The implied volatility was not even there, and that is Wendy's. You bet the hedgies bought call options yesterday, and they pumped the stock in the morning in the pre-market, and here it is. Gains in the tens of thousands, percentage-wise. even though the stock was up about 25% versus, say, Clover, which was up over 100%, and therefore the implied volatility is very important and critical for any options trader. So where does that leave us in terms of screening for the next meme mania stock? Let's go back in memory earlier in the year, during the first episode of the Meme Stock Mania, as we started to see GameStop, AMC, BlackBerry, garbage, horse manure climbing higher due to short covering. The trick at the time was, while everybody was concentrating on GameStop, AMC, BlackBerry, etc., guys like me were looking for boring stocks with relative high short interest. One of these stocks was Kroger, which is a stock that I've been holding in my portfolio since last year. But the stock at the time, earlier this year, had about 10% short interest, which is high for a boring stock like Kroger. The hedgies and the shorties started to panic, and they started to cover for their short positions in these boring stocks. The likes of Kroger and VMware. And in the case of Kroger, and I remember this precisely because I owned the stock, so I sold massive amount of out-of-the-money call options as the stock started to pop higher. These call options were so expensive, they were out of the money, and they expired out of the money, so I ended up collecting the entire credit. And this was one of my most profitable trades ever. And the reason is, a boring stock like Kroger had pretty much zero implied volatility. All of a sudden, we're seeing short covering in the name and it pops higher significantly. But that was back then. This time around, it is just for fun. They're pumping Wendy's, which has no short interest to begin with. They're pumping anything they can via call options. And I caught two of these in the morning. Number one, the ticker PLAY. This is for Dave & Buster, another garbage business, pretty much a bankrupt company. But these are the kind of companies and stocks that the new generation of investors, the SPAC generation, likes. So I took a trade in this one, Dave & Buster, buying calls early in the morning and dumping them by the end of the day. Likewise, another ticker, ASTS, and this was amazing because in the morning, as I'm watching, by the way, you're not going to be able to catch these in real time unless you have a Bloomberg terminal. But you can use other platforms, the likes of Barchart, for example. You're just going to catch them a little later than real time. Anyhow, back to ASTS, and who cares what this company even does? It's a ticker, and that's all they care about. In the morning, I saw intense call options buying for the 15 calls expiring in July. Right away, as the stock started to move higher, I followed this trade. Again, this is a day trade, meaning I bought the call options in the morning and I dumped them by the end of the day. And this was a quick 1,000% profit. For now, I don't have any meme stocks in my portfolio, stocks or options, with exception of Workhorse or Workhouse or Whorehouse. Who cares? Does the company even exist? But again, for the apes, the SPAC generation, that doesn't matter. They're looking for a mechanical squeeze one way or the other. I have call options in this name. I've already made my VIG, took back my principal plus a sizable profit, and I am letting the rest of the house money ride, whether it goes up, down, who cares? These are all pump and dump schemes. Trade them with this understanding. I'm sorry, but AMC is not going to go to 10,000, 100,000, or 500,000. It's a pump and dump. It will come to an end, and the end will be tragic. For all you know, this is a trick from Wall Street and the insiders creating this massive sinkhole, the meme stock rally 2.0. And here comes retail traders with their blindfolds on, running Naruto style, heads first, buy first, ask questions later. Matter of fact, don't ask questions at all. Just follow the hot trade, the new shiny object. For all you know, they lock all of these retail traders and investors in these meme stocks and the likes, and then fire in the hole. Finish them once and for all. Why would they do that, by the way? Well, we got some macro data in the morning regarding jobs openings. What a blockbuster number this is. Over 9 million jobs open right now, as we speak, unfilled, which, by the way, will spark the conversation of wage inflation. But if companies are struggling to fill these jobs, they got two options. Number one, raising wages and incentives. Number two, crashing retail traders' Robinhood accounts. For now, nobody wants to take these jobs, even though the companies are offering incentives and iPhones and yada, yada, yada. And they're blaming it on the $300 a week. Oh, the government is giving people socialism and handouts, and nobody wants to work. Are you that stupid? $300 a week? That's the incentive for people to stay at home and not work and make actual money? That's not the whole story. There is another side, which is number one, a lot of Gen Zers figured out how to cheat the system, how to use technology and social media to gain their independence. For example, using YouTube, TikTok, Twitch, Roblox, OnlyFans, Etsy. They're using these platforms to make some money. Add that to the unemployment benefits and the stimmies, and now you have some sort of independence. You don't need to rush and take a job right away. But here's the second reason. And nobody wants to talk about this, by the way. Not even the financial news media. The fact that the stock market is still trading in mania bubble territory. So long as these retail traders, specifically amateur retail traders and investors who invaded the market since the March bottom of last year, are making money in the market, whether it is paper gains or meme stock manias, options, it doesn't matter. So long as they're sitting at gains and the market is still friendly to them, meaning the meme stock mania is still alive, there is this illusion from new retail traders and investors that they have figured it out. They hit the jackpot. They figured out a new way to make money without needing to work. You log into your Robinhood accounts, you buy some call options in a meme stock, it pops higher, and there you go. Who needs to work at McDonald's anymore? We know how this will end. It will end badly, and as soon as it ends, these jobs will be filled right away. We saw the same phenomena back in 2000 during the dot-com bubble, the day trading boom. A lot of people quit jobs. There was an insane amount of jobs openings unfilled because a lot of employees thought that they have figured out another way to make money, the easy way. And of course, we all know how that movie ended. Because if you are joining the market thinking that it is a video game where you can score big, fast, and quick, think again. It will not end well unless you are a disciplined trader and investor for the long term. And perhaps this is what the Robinhoodians and the apes mean when they talk about the moon. We're going to the moon, bro. Perhaps by the moon, they mean McDonald's. Because once the fire in the hole episode happens, retail traders are all trapped in. These meme stocks, they're all in, some on margin. The Wall Streeters and the likes, they pull the rug, fire in the hole, massacre all of these retail traders, and all of a sudden you'll see job applications for McDonald's skyrocketing. So that is the moon, bro. The ultimate destination. In the interim, until the mania ends, perhaps McDonald's should also join the mania and exploit it by raising cash from these retail investors, the Redditors, the apes, and the likes. And here is my suggestion. If you're an executive at McDonald's or one of the marketing team members, and by the way, full disclosure, I'm going to buy call options ahead of time before this proposal takes place. I don't know if that's legal or not, but who cares? The SEC is in a coma. And my suggestion is for McDonald's to change their name for at least 1 month to the moon. McDonald's, that's the old name. The new name is the moon. And right away, the stock will skyrocket higher, 20, 30%, just like you saw with Wendy's today. You know what the new jobs are going to be? The highest paying job in this mania? Meme directors. Every company is going to have a meme department, and the meme executives will be the highest paid executives. This is the world, the freak show that we're living in. And here's the second main story for the day. The collapse of Bitcoin and cryptos. It's not looking good for the tulips, and Bitcoin looks like it will crack the 30,000 level of support and go all the way down to 20,000. Still early to say, but once again, you and I heard the news about the Colonial Pipeline. The US government was able to recover the majority of the extortion money that was paid in cryptos, specifically Bitcoin. And now Bitcoin has this bad reputation of being a tool for criminals. Add to that the fact that Reverend Elon Musk is no longer a fan of Bitcoin. Not a good setup here for Bitcoin and cryptos. And remember all of those pumpers? Well, now they're dumping and they're saying, oh, it's risky. You didn't know that before? When you pumped Bitcoin and attracted all of that retail money in the tulip? Oh, now it's risky, right? Just like Elon the Con, all of a sudden saying, oh, I just realized that Bitcoin is bad for the environment. Oh, you didn't know that when you pumped Bitcoin? The message here is, be careful. While you believe that you are part of the apes and the Wall Street bettors, sticking it to the man, bro, for all you know, your comrade is actually a hedgie, pumping the stock to make a quick buck. and leave you holding the bag, or shall we say hoodling the bag. Likewise, the backstabbing already started. Some of the apes are now chasing the next shiny object, whether it is Clover or Wendy's or whatever it is. Meanwhile, AMC stock is becoming boring once again. Anyhow, this is the Freak Show, and we have a lot to talk about, but let's start by covering the market's performance today. And here we go. The Dow Industrial Average closing in the red, down 31.67 points, or a decline of 0.09%. The Nasdaq, as expected, the outperformer, closing in the green by 43.19 points, or a gain of 0.31%. The S&P 500 also closing in the green barely by 0.71 points, or a gain of 0.02%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, real estate. The outperformance of real estate is notable this week. Number 2 for the silver, consumer, cyclicals. And at number 3 for the bronze, industrials. Meanwhile, the laggards of the day led by industrials, consumer defensives, and healthcare. What about the advance to decline ratio? While the performance of the indices was not that impressive, the market breadth remains healthy. For the NYSE, 67% advancing versus 30% declining. The Nasdaq, 60% advancing versus 36% declining. Moving on to futures. And once again, while the inflation deniers are having a massive orgasm, yields are down massively, and the last jobs report was supportive to the theory, at least in the interim, until we get the CPI number. But one thing that is not supportive for inflation deniers is the performance of commodities. We're not seeing a massive pullback in commodities. Matter of fact, a lot of these commodities are reversing higher once again. For example, crude oil closing above 70 once again. The WTI and Brent both gaining about 1.5% apiece for the day. What about softs? Lumber continues to be the underperformer, and the threat for lumber here is breaking the 1,000 support level. The chart has a massive head and shoulder topping formation, but there is a fundamental reason behind the underperformance of lumber futures, because building projects are being delayed across the country. And the reason is lumber prices are too high. It doesn't make sense for the builders or the buyers. For example, when lumber was trading above 1,500, that in turn inflated home prices here in the US by about $30,000. Now, the median home price is a little over $300,000, meaning that lumber prices alone were responsible for about 10% increases, at least in home prices. That is not counting copper and other materials. So the Fed might have an argument here by saying, hey, look, with lumber prices, the inflation in lumber was transitory. They're winning for now, but there is no proof that the mania in the housing market is over. We have no guarantees that the mania has stopped and it's not coming back. For all you know, if interest rates start to rise again, then a lot of those buyers who put their plans on hold will start to panic again, and they will start stampeding to buy homes, whatever supply available, before interest rates or mortgage rates climb higher, and that will in turn ignite another rally in lumber prices, because if the demand is here, builders will have no choice but to continue to build and pass that extra cost to the end customer. We also saw declines for coffee futures, but the rest of the board closing in the green, led by sugar, cotton, OJ, and coca futures. What about metals? Muted activities for gold. Meanwhile, we have losses by about 1% for silver. And by the way, remember that unusual options trade against the SLV that we covered a few days ago? It looks that that particular trade is working for now. We also saw declines for platinum and palladium futures, while copper finally bouncing back. But is the bounce sustainable or not? Because copper is bouncing from oversold conditions, yet the dollar is also climbing higher. Now we know that copper doesn't like a higher dollar. But in recent weeks, we saw a correlation between copper and the US dollar, meaning as the US dollar started to decline, so did copper. And now as the US dollar starting to bottom and recovering once again, copper is also trending higher. This is an interesting phenomena that we have to watch carefully. What about meats? Modest declines for lean hogs and feeder cattle futures. Meanwhile, live cattle futures closing on the flat line. What about grains? We have modest declines here for rough rice, meanwhile declines of about 2% for canola futures. Other than that, we're seeing gains, massive rebounds across the board. I mean, you take a look at these charts, for example, oats, a massive rally from the bottom, pretty much reversing the entire move to the downside. And that sparks the debate. Is inflation really transitory? How could it be transitory when commodity prices refusing to crash? They continue to recover at every correction and making higher highs. Moving on to the big casino, the options market. What's going on here? Here it is, number one. Not Apple, not Microsoft, not Tesla, not Amazon, but Clover Health. A SPAC name from Predator Chamath Palate Potato Tequila. With about 1.3 million contracts, about 77% of those were calls. At number two, Apple with about 1.3 million contracts, about 81% of those were calls. Think about it. Clover Health traded as many options as Apple, the biggest stock in the world. If this is not peak mania, I don't know what is. But here it is, number three. Ape Nation AMC with about 1 million contracts, about 63% of those were calls. Notice that the volume is frizzling for AMC. It was about 4 million contracts at the height of the mania. Now it's down to about 1 million. So a lot of these options traders migrated to Clove, BlackBerry, and other names. Moving on to the unusual activities that took place in the options market today, starting with the ticker EWJ. This is the Japanese ETF, and somebody's making a bearish bet here by buying these 65 puts. Expiration date July 16th, with expectations that the name will drop over 6.5% by then, and they paid about 25 cents a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the trade for the ticker NCLH, Norwegian Cruises? They're buying the 39 calls, expiration date June 18th, next week, with expectations that the name will rise over 15.5% by then. They paid about 11 cents a piece to enter this trade. All in all, bringing the total to about $300,000. We're going to ignore the trades for Clove and AMC. This has become an extreme mania, a casino, and these trades are not going to tell you anything at all. They're shooting in the dark, up and down. These are lottery tickets, and they are becoming extremely expensive lottery tickets. But what about the ticker TWTR for Twitter? They're making an aggressive bullish bet here by buying the 70 calls, expiration date August 20th. With expectations that the name will rally over 19% by then, and they paid about $1.75 a piece to enter this trade. All in all, bringing the total to about $2.5 million. What about the trade for the ticker SOFI? SoFi. They're making a bullish bet here by buying the 25 calls, expiration date this upcoming Friday, June 11th. With expectations that the name will rise over 16% by then, they paid about 70 cents a piece to enter this trade. All in all, bringing the total to about $800,000. What about the trade for the ticker ARKKKKKOS? They're making a bearish bet here by buying the 104 puts, expiration date June 25th, with expectations that the name will drop over 8% by then. They paid about $1.15 a piece to enter this trade. All in all, bringing the total to about $1 million. Lastly, what about the trade for the ticker IWM? This has become a proxy for meme stocks, rallying along them, but it will also crash with them. And in this case, they're making a bearish bet by buying the 216 puts, expiration date June 30th, with expectations that the name will drop over 7.5% by then, and they paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $800,000. I was about to say $800,000. Moving on to the heat map analysis. What's going on here? The market remains boring, trading in the green slightly, but the devil is in the details, by the way, because on paper, the Nasdaq is leading the market. But when you look at the core of the Nasdaq, the big cap technology names, and the semiconductor names, they're actually underperforming. underperforming. You have names like Taiwan, Micron, Nvidia, AMAT, Lam Research down big today, along with some of the big cap technology names also underperforming like Microsoft, Facebook, and Google, while Apple closing in the green slightly, and you have Amazon rallying by about 2% or so. Who knows what's going on there? Perhaps Jeff Bezos not paying taxes optimism. But the rally is happening in small caps, specifically the mania names, the high multiple names, the highly shorted names. These are rallying higher, along with the travel names, and the real estate sector of the market has been outperforming for 2 days now. The notable theme is the inflationary trade. We're seeing the energy sector, industrials, and even materials catching some bid, while the financial sector is underperforming today. And the reason is yields were down. But watch the option grid carefully, specifically the KRE, the Small Regional Banks Index. I'm going to watch that one carefully, yes, tomorrow, because tomorrow is Wednesday. And then the very next day, Thursday, we have the CPI number. So if we see options traders buying significant amount of call options for the XLF or the KRE, that will be a positive indicator that the CPI number will come out hot and yields will pop higher once again. Moving on to the themes analysis, starting with the reopening names, aka the nostalgia stocks, outperforming the market today with very few exceptions. We saw massive gains for names like Southwest, Helton, MGM. Look at the Cheesecake Factory, up about 8% for the day. Planet Fitness, about 2.5% gains. And these names will continue to catch a bid and outperform. The dips will be bought. And the reason is every fund manager out there is betting on the reopening theme. Now, the moment of truth will come out during the third quarter's earnings, because that will happen after the reopening phase during the summer and the stampede, the splurging in the economy. And we will see whether these companies actually compensated for their pandemic losses or not. What about the inflationary trade? Mixed picture. Financial stocks are underperforming. Meanwhile, commodities and infrastructure stocks are outperforming, because we're seeing commodities reversing higher, specifically for these two names, Alcoa and Martin Marietta. These names have been outperforming significantly since the beginning of the year, but we saw a nasty correction the last few weeks, and the question is, where is the bottom for the correction? Will it be the release of the CPI number on Thursday? This is what I'm watching for. What about the deflationary names? Not outperforming by much. Matter of fact, muted even when we're talking about the high multiple names. And once again, there is a massive distraction going on in the market right now. Market participants are not chasing these names. They're not buying dips in regular stocks, and instead they're chasing the meme stocks. The question remains, at what point will the distraction be too big to ignore? When retail traders and investors start to pull some of their positions, the winners, Apple, Microsoft, Tesla, etc., to raise cash to chase the meme mania. There is a threshold, there is a point, an inflection point where the meme stock mania will grow too big and spill over into the broader market, creating a sell-off. Because in addition to retail traders selling their winners to fund their memes, you get a half short covering from hedge funds, and hedge funds will have to sell their winners too. This is exactly what we saw during the first episode of the mania in January and February, and the market slid through that and recovered. The question is, will the market be able to stand during this episode of the mania, or will it be the knockout punch? Moving on, charts, and we are starting with AMC. We talked about the wedge consolidation. You can call it a wedge, you can call it a triangle consolidation. It doesn't matter to me. It's a clear pattern of higher lows and lower highs. You adjust the slopes based on the points with the highest reaction, and then you have a triangle consolidation. The big question is, how will it be resolved? Let's read from the Smarty Pants, the technical analysts, and they call it a symmetrical triangle pattern. The symmetrical triangle occurs quite frequently and is essentially a trading range that is contracting. The upper boundary, which is a resistance, is a short-term trend line that is sloping downward. The lower boundary, which is support, is a short-term trend line that is sloping upwards. The stock price repeatedly bounces off these upper and lower trend lines, and it is contained within these limits. The completion of the pattern occurs when the stock breaks out of the contracting trading range, which can be in either direction. The breakout usually occurs before the upper and lower trend lines converge together. The time period that the stock remains in the trading range varies from a couple of weeks to a couple of months. The longer consolidation periods lead to moves that are more significant. So here it is. It appears that the breakout happened to the downside before the upper and downward trending lines converged. What happens next? If the lower boundary is penetrated, then the price movement will usually move down by a minimum distance. The profit target is determined by the distance from the first relative high to the first relative low of the symmetrical triangle pattern. The distance is then added to the breakout point for an upside breakout or subtracted from the breakdown point for a downward breakout. Short-term stock traders, such as swing traders, frequently use these profit targets by trading the breakout and exiting at the profit target. So using this information, here is the distance from the first relative high and the first relative low. The stock dropped by about 48%. We're not concerned about the percentage, we're concerned about the distance. If we apply what these smarty pants are saying, this is what we get. The stock will drop by about 63% or more. And the ultimate destination will be about $20. We'll see how strong the apes are. Of course, the psychology becomes supreme here. If we continue to see more shiny objects where the call options print more, whether it's Clover, GameStop, McDonald's, Wendy's, Dog Shit Incorporated, doesn't matter. Whatever stock that's going to print more and becomes the distraction, we will see that will be a test for the apes. How strong will you be holding on the AMC tree with no bananas? And you're looking around and the Clover tree has more bananas. The question for the apes is, will you stick to your tree while the grass is greener on the other side, or will you hop to the other side, jumping from one tree to the other, chasing the banana? And the last thing I want to share with you when it comes to AMC is the following. Remember this chart, how manias start and how they end? You have your takeoff, the first sell-off, and everybody assumes that the mania is over. What do you know? The mania pops up again to even higher highs this time around. You haven't seen anything yet. And then you see the media attention phase, enthusiasm, greed, delusion, and then the new paradigm, where the hoodlers of that particular stock or market say this is the new normal. You don't understand, bro. The game has changed. We're the captain of the ship now. And then the stock goes down. You have the denial. It bounces higher again. Everybody says we're back to normal. These are just weak hands, paper hands, weak apes. And then what do you know? The stock starts to slide down again, leading to the fear, capitulation, and finally despair. What if we apply that to AMC's chart? I'm not making any assumptions. I'm just saying, could that be applicable here? Is the chart in the return to normal mode right now, which will be followed by a massive sell-off leading to fear, capitulation, and then despair? We will see. Moving on to the human market, the SPY 30 minutes chart. What's going on here? Nothing at all. The chart is still struggling to break above 423. That is the current resistance line. We're not going to turn bearish until we go down all the way to 420. Even then, the chart will not turn bearish because going back to 420, catching the support, gathering more energy, strong enough to break above 423. However, I will turn bearish against this chart if the 420 level of support fails, and then ultimately the 417.30 level of support is broken, because that will lead to a massive correction in the SPY. For now, the chart is consolidating, looking for energy, looking for a catalyst to break above 423. What about the daily chart? For the continuous contract, for the SPY. Once again, 423 for the SPY is the equivalent of 4,232 in the futures chart. And the SPY is just consolidating here, trying over and over and over again to break that very intense, very sticky level of resistance. And matter of fact, if we zoom in to a 30 minutes chart, this is the fifth attempt where the S&P 500 futures try to crack above 4,232. Is this good? Is this bad? For now, it doesn't tell us anything. It tells us that this level is extremely difficult to break above, and the S&P 500 needs a catalyst to break above that level. It's not strong on its own to do the job. But you fail once, that's okay. You fail twice, that's okay. But you fail for the third time, now we're going to start asking questions. I'm not making any judgment here one way or the other. The S&P 500 remains positive. It remains bullish. The assumption is, for now, that the level of 4,232 will will be broken, but this is a continuous contract. You can watch this chart during the evening. If you see the chart starting to pull away to the downside from 4,232, then the chart is speaking loud and clear by saying, I don't have enough fuel in the tank to break above this level. I need to go down to a support level to get new blood, fuel the tank, and attempt again. What about the NASDAQ 30 minutes chart? The NASDAQ has been leading the market so far this week, as we expected, by the way. But Judgment Day is coming very close. Thursday, the release of the CPI number. The SPY not looking so bad, but the cues from the action today looking a little bad because we have a bear flag formation, a mini one. This is a 30 minutes perspective. It is not significant when you pin it head to head to the daily chart. For now, we know that the resistance is 340. Meanwhile, the support all the way down at 330.5. Here is the daily chart. We have the pin look, doji, whatever you want to call it. All of what this says is that we have indecision when it comes to the NASDAQ. The tech sector, the high multiple names, led the market for 2 days, but now we're getting closer to a very important piece from the macroeconomics data, the CPI number. So there is an indecision mode here, not sure whether to bet higher or lower. All we know that this pattern usually, not always, but usually results in a massive big move right away, the very next day or 2 days at the most. And if it is a big pop, say the CPI number misses, we have a cool inflation number, the NASDAQ will rally all the way to at least 14,000. But if the number comes out too hot, the assumption is that the NASDAQ will reverse and break the support of 13,599. Moving on to small caps, the IWM 30 minutes chart, rallying along with the meme stocks. And yesterday we talked about the IWM being a proxy for meme stocks. If you feel that the options are too expensive for AMC, GameStop, etc., perhaps you want to trade options for the IWM. They're still cheap. You can bet either way, up or down. For now, we have a trading range, it looks like, with defined highs and defined lows. We're at the highs now, and the assumption is, looking at the RSI overbought levels, from a 30 minutes perspective, the assumption is that the chart will pull down, perhaps all the way, but not necessary, to the support line within the trading channel. What about the daily picture, the RUT, the Russell 2000? The bulls are solidifying and cementing their advantage by trading away to the upper side from 2,264. But remember, I look for the weekly closing. For now, the bulls have the advantage, but who knows how the week will close. And the fate of the Russell 2000 is now unfortunately dependent on the fate of meme stocks. And here's another thought, by the way. If meme stocks are growing so large that they're waiting in the Russell 2000 becoming too extreme, we're going to have rebalancing. When we have rebalancing, the IWM will start dumping meme stock shares. That's not going to happen right away. The rebalancing for the Russell 2000, I believe, will happen during September, but I'm not sure. Moving on to the Dixie, the dollar index, keeping the 90 level for support, and this is important because for now, keeping the 90 level will open the path for the dollar index to pop higher if the CPI data comes out too hot and the tapering discussion starts to become front and center once again. My bet here that the US dollar will pop higher, and if I'm wrong, I'm wrong. Who cares? Find yourself another channel. What about gold? Trading as the inverse picture of the US dollar. The US dollar is keeping 90 for support, and you're starting to see gold hitting the brakes. The assumption is the dollar will pop higher, and gold will pull back all the way to at least 1850. And here it is, the chart of the day, the 10-year Treasury yield, breaking the support of 1.55 basis points. And the line in the sand is 1.5%. We know that the Federal Reserve is doing a proxy operation twist and manipulating yields lower. They don't want yields to surpass 1.7%. They want to keep it in range until they're ready and prepared to talk about talking about tapering. The question is, will the CPI number be too hot to ignore, or even the Fed's manipulation is not going to work anymore, and we see yields finally reclaiming and recovering 1.7%. Who knows? But here's the question from the viewers, saying, why is the CPI number so important if it's going to be fixed anyways? The answer is, we know that the number will be cooked and tamed, sliced and diced. But there are limitations to the cooking. We know that used car prices continue to surge higher. We know that energy prices, specifically gas prices, surpassed $3. This is the nationwide average. But here in California, it's well above $4 a gallon. But we have the sleeping giant, which is rent prices. You have big cities, the likes of New York, Los Angeles, San Francisco, where rental prices have not recovered yet the pre-pandemic highs, but they are recovering extremely fast as the vaccination rate continues to climb higher in these cities. Furthermore, we have the eviction moratorium that's going to expire, and you're going to have landlords across the country evicting their current tenants for good or for bad. And the reason is they cannot raise rent on their current tenants. There are limitations to how much you can raise on your current tenant. But if you kick them out for whatever reason, you can make up a reason and then replace them with new tenants, you can charge market prices. And you're going to see landlords across the country engaging in this practice. That would lead to a massive homelessness crisis in the country, and it will also lead to rental prices skyrocketing. It will be a nuclear move to the upside, and that will push the CPI to levels that the experts and the economists haven't even imagined. What about bond prices? The TLT weekly chart looking good for now. You're seeing the momentum indicators strengthening. Furthermore, we have a pattern of higher lows, at least for now. I don't need to bore you, but once again, the CPI number will determine where this chart will go. The assumption is the CPI number will come out hot, the TLT will consolidate or go lower. But what if the number comes out too cool and the cooks at the kitchen do a magnificent job? Then we will see a massive pop in the TLT. And therefore, a lot of traders are buying call options ahead of time. I don't blame you. This is how options trading work. You take the shot, you take the risk, but part of that is also assuming the risk. You're not gambling your entire portfolio in this one. You're buying some out of the money calls, short term, expiring this Friday. And if the pop happens, it happens. If it doesn't, you lose your money. End of story. But you're not going to cry over spilled milk because you did not bet your entire portfolio on a single trade. What about the VIX? Yesterday, we talked about the bet against the VXX, the put option trade, as a contrarian indicator to where the VIX is heading. And that is working for now. They're spending millions of dollars buying VXX puts or selling VXX puts. Meanwhile, the VIX is popping higher slightly, not by much. And again, I leave the question for you. You got two charts, the VIX and the SPY, the S&P 500 futures. The VIX looks like it is bottoming from the last leg down. The SPY futures knocking and knocking and knocking at heaven's door. That happens to be 4,232. Put these two charts together. Will the SPY break above 4,232? Or will the VIX pop higher and the S&P futures get rejected once and for all? If you are laying a bet right now, which side will you bet on? Will you bet on the S&P 500 to crack above 4,232 or get rejected from it? And again, this is not DraftKings. You're not going to make any money, at least not from this channel, but you can make money from your trading account. This is the bet for the week, and the VIX will pop higher if the SPY, the S&P 500 futures, get rejected from the most important level of 4,232. What about Apple? 30 minutes chart. We talked about the support level of 125 getting retested and reconfirmed for support. There was the green light for Apple to blast higher. We saw that right away in the morning, but the stock closed below the highs. For now, we're not reading too much into it. There's a gap left in the morning. That could be a destination for a retracement, but for now, Apple is looking good. What about Tesla, the souffle? Not looking so hot so. Matter of fact, we have a bear flag formation from a 30 minutes perspective, and it looks that the chart is pulling back before giving it another shot at cracking 629, waving the white flag before the battle even started. This is a bad signal for Tesla. And by the way, watch the IV rank for the souffle. It's about 7%, meaning that these options are extremely cheap. If you foresee a massive move for Tesla, up or down, this is the time to start accumulating options for the name. What about the RKK? I have some call options on this name, and I'm planning to dump them by tomorrow, before the CPI release. So I'm in Team Mama Kathy. Go Kathy Wood, to the moon. And by the moon, I mean 115. That will be good enough for me to exit. What about the tulip market? What are the main stories for the day? Again, not cracking below 30,000. That's the support and the most important level for the crypto maniacs to keep. If you don't keep that one, good night. You're done. It's over. For now, the chart is trading within range. The support 30,000, the resistance 42,000. I know a lot of channels out there saying that Bitcoin will crash, it's over, it's done. It's not over until you crack 30,000. Absent of that, there is the possibility that Bitcoin will spring back and trade within the range for a longer period of time. What about Doge? What's going on here? Not looking so hot, so surprise, surprise, Bitcoin is down, so is Doge. But the level I'm watching here is the middle ground between the support of 21 cents and the resistance of 45 cents. That will be at around 35 cents. We're trading below that level. For now, the bears have the advantage, but so long as the chart trading above 35 cents, the bulls have the advantage. What about ETH, Ethereum? Looking a little better than Bitcoin because it's not making lower lows and it is reclaiming the level of 2,500 for support. At least for now, it's keeping 2,500 for support. If that level is broken, then we got a problem. And the likelihood is that ETH will suffer from the bear flag formation playing out, and the destination for that will be cracking below 2,000, the most important level to keep. 2,000 for ETH is the equivalent of 30,000 in BTC. So if the bear flag plays out, the destination at minimum will be around 1,400 for ETH, and that will be a massive drop in the current price. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have wholesales inventories. It is an important number, but not that important. The talk of the town will be the upcoming CPI number, the initial jobless claims coming up on Thursday. So tomorrow, it will be a strategic day for the market. If you're a smart trader, you perhaps bought the NASDAQ and the mania names, perhaps some meme names. They popped on Monday and Tuesday. Perhaps tomorrow is a day to take profits. The goal is to reduce your risk exposure before the big number, but you also should place some bets, wild ones, whether the number comes out too hot or too cold. If it comes out too hot, the TBT will pop higher, the TLT will crash, and the NASDAQ, the high multiple names, will also crash. Meanwhile, the dollar index will pop higher. If the number is too cool, TLT will blast higher, TBT will crash, that is yields, will go down, the dollar will go down, and the NASDAQ will pop higher significantly. So you're going to have some bits here and there, wild shots, but you should also reduce your exposure for bigger risk than your portfolio might be able to absorb. And the reason is, for all you know, we know that the Biden administration and the current cooks at the Bureau of Labor Statistics, they cook the numbers right down the middle. They like it to be medium rare, an aristocrat. And if the number comes down the middle, the market could become confused and not move at all. So that is the risk assumption. Trade wisely. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.